Hey everybody, it's Paul from Cary Estate Planning. As we've promised, as we forecasted over the last couple of weeks, actually the last couple of months, in our newsletters, in our social media presence, on previous videos we've done, when Congress put out a bill, we would be sure to analyze it and give you our thoughts, what it looks like, what it does, where we go from here. And so within the last week or so, the House Ways and Means Committee, which is where financial bills come from in the House, has released a budget reconciliation bill. That's sort of the first lob at a general budget reconciliation package that intends to provide about $3.5 trillion in funding towards human infrastructure projects, along with potentially up to $3.5 trillion in additional tax revenue provisions. So I wanted to go over that, just sort of hit the high notes, let you know what it looks like, where it is in as it pertains to where we thought it would be, what's there, what's missing, what was expected that didn't make it, things that are in there that we didn't expect, right? So first off, keep in mind, this is a bill. It is a draft bill, and it is something that has, to this point, as of today, only made it out of committee, right? So it hasn't been passed by the House. We haven't seen anything from the Senate yet. And it certainly is not a final bill. It certainly is not a law, right? It is not likely to move forward as is, because the Senate hasn't had their say yet. We generally need a bill to pass both chambers of Congress before it can go to the president for signature and become a law. So with that said, this is not where the bill will end up being. These are not active tax changes. These don't actually have any effect yet. These are just proposals, but it's giving us an idea of where Congress is aiming, where the Democrats are aiming in terms of priorities. So first and foremost, as everybody expected, we're going to have income tax adjustments, right? We're going to have corporate tax adjustments. So on the income tax side, the top individual rate for income taxation is going to go up to 39.6% from the current 37% under what was the tax reform package from 2018. And that's basically where it was. So that's a rollback of the tax revisions that were passed back in 18 or 17 that were effective in 18. And the bracket, the top marginal rate, or the top, this top percentage is going to apply to individuals who make more than $400,000 in adjusted gross income, and married couples who make more than $450,000 in adjusted gross income. We're also going to see an increase in the top capital gains rate, and that's going to go up to 25% from its current rate of 20%. So an adjustment, but it isn't what was expected from the Biden proposal, which was to match it with income tax, to have the same tax consequences for income as for capital gains. So it's nowhere near expectations. We're also going to have, this was somewhat of a surprise, an additional 3% surtax on individuals who make over $5 million a year in adjusted gross income. So that was not necessarily expected, somewhat of a surprise. On the corporate tax side, we're seeing increases, but not as much as what was expected. So the top corporate tax rate would move to 26.5%. There was an expectation that it would go up as high as potentially 28%. Some are expecting it to potentially land at around 25%. Obviously, we're not 100% sure, but that is going to be the top corporate tax rate, and it's going to apply to entities that file as corporations. So this is not applying to pass-through entities like LLCs, S corps, or sole proprietorships. It's going to be C corps, and it's going to be those that make more than $5 million in annual income. The rate for those that make between $400,000 and $5 million will be 21%. And the rate for companies that make under 400,000 would be 18%. So it is still a graduated tax scale. There is obviously clear ranges for that. One proposal that I guess didn't line up with reality in this bill was, the Biden administration had really pressed for a corporate foreign earnings tax of 21%. Its current rate is 10.5%, and under this bill, it would go to 16.6%. And keep in mind, if you've been paying attention to international tax news this year, we generally would have expected, or we should expect, some alignment and agreement throughout the international community at about a 15% for an earnings tax or a minimum tax. And so there was a lot of concern that if the United States was taxing at 21%, it would put us at a significant competitive advantage compared to other companies or in other countries. And so having it at 16.6 when most other countries would be at 15 is not such a drastic difference that it may provide negative consequences. You never really know. We're also going to see increased taxation on tobacco and nicotine producers, which is somewhat of a surprise as well. One piece that was not in this bill is an adjustment to the state and local tax deduction. So prior to the Trump tax reform from 17 and 18, there was the ability at the federal level to deduct your state and local taxes from your federal return. And the tax reform package that came into effect in 18 capped that at $10,000 per year. And obviously that's pretty detrimental to individuals who live in the states of like New Jersey, New York, California, Pennsylvania, where they have significant state and local taxes for property, for income, and what have you. And so this has been a pretty significant piece of the negotiation, especially with Democrat House members in those 3 or 4 states. And it could honestly be a deal breaker because there was no movement on that piece. There is no change in the current deduction cap for what's called SALT, state and local taxation. And so this could be a deal breaker, right? This could mean that this version of the bill will go nowhere if it doesn't have the support of Democrats in these 4 states. Another aspect of the bill is going to be increased funding for IRS investigations and enforcement. And the idea there is to generate more revenue by finding more violations, conducting more audits, and just sort of increasing revenue through finding more revenue, right? One aspect that was expected, I would say, is an acceleration of the already existing estate tax exemption sunset that was expected for 2025. So the Trump tax reform package from 18 basically doubled the estate tax exemption for a certain period of time, right? It was supposed to expire at the end of 2025. And so at the end of 2025, we were going to go back down to the 2010 rates adjusted for inflation. Back in 2010, it was $5 million per person. And obviously that increases a little bit every year. And so instead of that waiting until the end of 2025, it's going to happen this year, right? If this type of bill or if this type of provision passes. And so what that means is that the exemptions for estate and gift tax will still be unified. We'll still have portability, but they'll likely be in the $6 million range, depending on inflation adjustments. And that'll be per person. So roughly 12 million per married couple. There's also an intention in this bill to limit or eliminate estate tax reduction strategies that are usually in the form of grantor trusts, like IDGETs or intentionally defective grantor trusts, some grantor retained annuity trusts, those sorts of what we call grantor trusts, right? They're basically irrevocable trusts that you're trying to manipulate the taxation of assets during your lifetime or provide some reduced amount of taxation after you're gone. So the limitation or elimination of those sorts of strategies. Another strategy that is sort of on the chopping block is the valuation reductions for minority interests in closely held businesses. And that essentially was a strategy that basically said, if you had a 1/3 interest in a privately held company like an LLC, it is not actually worth 1/3 of the full fair market value of the company, because a 1/3 interest in a company is a minority interest. It doesn't have marketability. There isn't a secondary market for it, usually transfer restrictions, and it doesn't have control. It's merely an interest or an expectancy, beneficiary type status. And so it shouldn't be worth, for estate and gift tax purposes, a literal translation of 1/3 of the fair market value. So generally there would be, somewhere between a 15 and 30% reduction in that value, depending on the type of business, the type of asset, those sorts of things. And so this bill would act to eliminate that ability. No more valuation reductions for these purposes. Of note, though, no capital gains inheritance changes, no changes to the step up in cost basis, no changes to the ability to defer, or that death is not a realization event for capital gains, which was going to be a game changer in estate planning, was going to be a game changer in 1031 exchanges, just generally. And then also importantly, no generation skipping transfer tax exemption changes either. So again, these are just where we stand currently. This is a bill. The bill has now passed the House Ways and Means Committee. It has not passed a full vote of the House. We have not seen anything from the Senate. We'll continue to do these videos every week until we have more clarity, just to give you, week by week update. Where do we stand? What's happened since the last video? If you have any questions, shoot us a line, paul@carystateplanning.com. And we look forward to providing you more guidance as this tax reform evolves.